Dave Ramsey may have helped you climb out of debt, but should you now follow his investing advice? What is an endorsed local provider, and should you hire one to manage your investments? And what free online tool can help you or your child find the school of their dreams? We'll answer these questions and more on this, the 69th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, everybody, this podcast is sponsored by Betterment, the most preferred automated investing service. Betterment has cutting-edge technology to optimize returns, minimize taxes, and save you time and money. Join over 34,000 customers who have already streamlined their portfolio management at betterment.com/roller. That's betterment.com/ROLLER. Hey, everybody. It's Rob Berger here again. Welcome to the 69th episode of the DoughRoller Podcast. I'm glad you can join us. We're going to be talking about ELPs today, ELPs, endorsed local providers. This comes from a question from a listener, wants to know whether Dave Ramsey's ELPs, as it relates to investing, are good for you, whether you should hire one or not. And so we'll talk about that on the show today. And I will give you my 2 cents on ELPs. I keep thinking ELFs every time I say ELPs. I wish you would have come up with a different name for those things. Anyway, we're going to be talking about ELPs today. Before we get to it, though, the money tip of the day. This is one I read about on CNN and thought I'd share it with you. And it's a website, a free tool called Admittedly, and it has a crazy URL. It's admitted, ADMITTED, admitted.ly. I didn't know you could have a site with the .ly at the end, but Admittedly has figured out how. And it's basically a site that will help folks find the right school, the right college or university for them. And it's free to join. And they have personality quizzes that you can take that match you to different schools. You can also figure out what schools are realistic for you, given your grades and your test scores and all that sort of thing. Which schools are kind of a reach for you, which ones are right in the target, and maybe which ones are you might consider as a safe school. And it has tips and resources to help you improve your chances and to plan college visits and to put together your application. I know. With our children, we went through the whole college application thing, and I guess things have just changed since I was a kid. I mean, when I was a senior in high school, just sent out a couple of applications and I was done. Now it's like it's this whole thing. You go to the school, your kid's high school for meetings, and you do that in the fall. And there's at least in Northern Virginia, it's just cram-packed with parents all convinced their children should go to Harvard or MIT, and maybe they should, I don't know. And paperwork to fill out and all this stuff and deadlines. And it's like, who comes up with this stuff? It's just insane. Well, I don't know. Maybe Admittedly can help you out a bit. Check it out. If you do, if you've used it, let me know what you think. Love to hear from you. That's the money tip of the day. Okay, so the main topic comes from a reader named Ace. He has some questions about Dave Ramsey's ELP program. Here's what Ace said when he wrote into me. He said, if you have time to answer, I just listened to your podcast about financial advisors, and let me just stop right now and tell you that is, I had written this down, hang on, podcast 62, DoughRoller.net/podcast 62. Okay. I just listened to your podcast about financial advisors. I'm curious about your take on Dave Ramsey's ELPs. I really like Dave Ramsey and his philosophy, but when it comes to how he tells people to invest, I feel like he might not have everyone's best interest in mind. From what I understand, these financial managers use front-load mutual funds. For someone so big on being smart with your money, I can't believe he would approve of this. But after doing research, I couldn't find solid guidance on any of his websites about mutual funds. I did see where he thinks retirement savings should be put into 4 different kinds of funds, mostly growth stock mutual funds. And he says to not invest any more than 15%, the rest should go towards your mortgage or saving for house, college, etc. Do you have any opinions on the whole ELP thing? He says these are folks that will teach his philosophy and that he approves of, but he's got to be getting a cut for advertising for them. Well, that's Ace's question. It's a good question, and I know a lot of people. Obviously, Dave Ramsey is a very popular personal finance personality. He's helped an untold number of people get out of debt. I think he's almost developed a cult-like following, really. And I think once he's helped folks really turn around their finances, they're probably going to listen to him pretty closely when it comes to investing. And I guess that's sort of the heart of Ace's question. And so we're going to cover that today. I'm going to tell you what ELPs are and my view on them. And then obviously you can decide for yourself. So I want to break down, though, a few things that Ace mentioned in his email. The first thing is, does Dave get a cut for advertising for them? My understanding, and I think this is reflected on Dave Ramsey's website, is ELPs do pay a fee to Dave's company as part of becoming, I guess, an endorsed local provider. I personally, if it's disclosed, I don't have a problem with that. I mean, there's no, to me, if Dave makes money from going to the trouble of evaluating, in this case, investment advisors and bringing them into his program, that's fine, as long as it's disclosed. To me, the better question is, all right, forget the financial arrangement for a moment. Are they worth considering? If you're looking to hire someone to manage your investments, should you consider an endorsed local provider? And that's going to be my focus today. That's the first thing. The second thing is, as I've mentioned, ELP is endorsed local provider. That is a Dave Ramsey term. That is not an industry term. You won't find that term at FINRA or at the SEC or on Wall Street. That is a Dave Ramsey. Let's come up with something to call this program, and I'll call it endorsed local provider, and we'll use the acronym ELP. So that's the Dave Ramsey term, and it covers more than just investing. Dave has endorsed local providers for things like insurance, taxes, mortgages, and so on. We're focused on the investing ELPs today, but just to give you sort of a background of that program, he endorses folks in a number of different areas related to personal finance and investing. The next thing is Ace mentioned a front-load mutual fund. If you've listened to a lot of my podcasts, I talk about things like Vanguard and Betterment and Fidelity, and certainly at Vanguard and the funds that Betterment uses, for example, they don't use front-load mutual funds. So I've not really talked about this much. What is a front-load mutual fund? A front-loaded mutual fund is a mutual fund that charges you a fee when you invest in them. And these are usually called, there's different classes of loaded mutual funds. These are Class A shares. And typically you pay about 5.75% right off the top. So now that may surprise some of you. Let's just make sure we're on the same page. If you were going to roll over from a 401k to an IRA into a A-share fund, a fund with A shares, front-loaded mutual fund, you had $100,000. You'd pay them right off the top $5,750, and then you'd invest the rest. So right off the top, they take, I think it's 5.75%. I think that's the standard. Now, there are B and C shares, which get into, there's maybe no upfront fee, but you pay a fee if you withdraw your money within a certain period of time. And they call those back-end loaded funds. We're focused today, and I'll explain why in a minute, with the front-load mutual fund. So you pay a fee as soon as you invest right off the top. Now, Ace also alluded to the fact that Dave Ramsey recommends growth stock mutual funds, and that's true. He actually has a very interesting asset allocation. His view is you should invest 25%, 1/4 of your investments in each of the following 4 categories of mutual funds: growth and income funds, growth funds, international funds, and aggressive growth funds. So he's big into the growth funds. And so you may be saying, well, okay, that's great, but what is a growth mutual fund? So let's cover that real quick. So, imagine a company, take Tesla. Tesla might be considered a growth company. A growth company, when a company just starts out and it's expanding like Tesla, it's coming up with new cars, new models, they're going to build a battery factory. So they're not paying dividends. Every dollar that they earn, in every dollar of cash flow, they're investing back into the company. And their goal, of course, is to grow their earnings. So what growth mutual funds do is try to find companies like that are growing their earnings above and beyond what might be considered average, if you will, in, say, the S&P 500. These are typically companies that they're growing so much, they're using all of their capital to grow that they don't pay any dividends, or they pay very little dividends. That's not a bad thing, by the way. It just gives you a sense of the type of company. It's the big up. A lot of times it's the companies you've heard about that are growing each year by leaps and bounds, not paying a lot of dividends, using that money, their cash flow, to reinvest it back into growing the company, expanding, introducing new product lines, and what have you. Certainly, there's nothing wrong with growth funds. I personally think it's a mistake to put, what is it, I guess 75% of your investments in growth funds. I don't know why someone would do that. That's my own view. But, Dave obviously has a different view, and that's his view on asset allocation. If you want to know my view on asset allocation, let me give you a podcast to listen to if I can find it real quick. Here it is. It's podcast 25, DoughRoller.net /podcast 25 will give you my view on asset allocation. But in any event, so that's a growth stock mutual fund, gives you sort of a little background on Dave's perspective. And with that, so I want to turn to these ELPs. And before I, kind of as part of a transition, I want to touch on another issue that's actually gotten a lot of attention. Dave Ramsey claims that you should be able to earn 12% on your stock portfolio returns, 12%. And that's gotten a huge amount of press. And folks have attacked him on that and said, Dave, you're crazy. That's just not an accurate statement. Historically, stocks don't return 12%, and it's ridiculous to assume that over the next long period of time, we're investing over the long term, stocks are going to return 12%. And I'll be honest with you, to my surprise, boy, Dave has stuck to his guns. I mean, he won't back down. 12%, that's what he's claiming. And I don't understand that. I mean, I think it's just wrong. And I don't know why you'd get so married to this 12% number. I don't know, but I guess he believes it. But historically, it's just not accurate. And I suppose we could make the assumption that over the next 80 years, the stock market will return more than it has since the last 80 years. But I don't know why one would assume that. And so anyway, that's my view. What he says on his website is, he says the current average annual return from 1926, the year of the S&P's inception, through 2011 is 11.69%. So I guess he's rounding up. I actually can't find any. He doesn't link to anything to support that claim. I can't actually support it. The closest thing I can find is a very good resource from the Bogleheads on the S&P 500 index. He picks 1926. Actually, their first index was really 1923, but then they created something in 1926 that tracked, I want to say, 90 companies. There was one in 1923, or maybe it was 233 companies. Anyway, the S&P 500, as we know it today, really formed in 1957, but you can track returns back to about 1926. According to the Boglehead wiki page, and they actually have the returns for every single year through 2013, the compound annual growth rate, CAGR, the compound annual growth rate is 9.92%. Now, Dave went through 2011, but actually it'd be higher because in 2012 it returned 16%. 2013 it returned over 32%. So tacking on those 2 years can't explain the 11.69% number. So I don't know where he gets it. Everything I've seen has always said 10%. I'm looking at an actual calculated number with all of the data laid out in front of me, compound annual growth rate of 9.92%. So I actually am trying to find a way to reach out to Dave's team to see if they can give me some support or data for that. One thing I will give Dave some credit for, on the 12% page on his site where he mentions this 11.69% number, he opens the page to comments, and boy, they're fun to read. I mean, it's just a battle in there. You've basically got investment advisors who know, or I should say believe, that 11.69% is not accurate. And then you have the Dave Ramsey followers on the other hand, and they're just battling it out. And I don't know, if you've got some time on your hand, it's worth reading those comments. Kind of entertaining. Anyway, this is just one area where I'm just going to have to agree to disagree with Dave Ramsey. I just don't see the historical support for a 12% annual return on stocks, nor do I think it's a realistic number going forward. That's my view. Obviously, Dave has a different view. I will add this, though. Even if we assume, and this gets us now to the ELPs, even if we were to assume that over the next, 40 years, the S&P 500 will return an annual compound rate of 12%. Let's just assume that. You'll never get that with an ELP. You won't. Why? Well, the 5.75% front load is one reason. We'll talk about some others as well. But even if you invested in a Vanguard S&P 500 index fund, you wouldn't get the full 12%. You'd get awfully close. An index fund would get you closest to that 12%, closer to that 12% than any other kind of fund. But a fund loaded with fees, of course, wouldn't get you the 12% because you got to pay the fees, right? So that brings us to the ELPs, the Dave Ramsey Investing ELPs. And to understand Dave's view on this, you really need to start with his investment philosophy. And he publishes it. It's a very detailed, thoughtful PDF. It's where I found his asset allocation views that I mentioned earlier. And he lays out his views on investing. In the first, and I think sort of the most important one, as we work through whether these endorsed local providers are something you ought to check out, is this. He firmly believes that you should not invest on your own. He says it right out. Pay a pro or do it yourself, ? He says without a doubt, pay a pro. Now, what's his reasoning? He says that statistics show that do-it-yourselfers are quick to jump out of funds when they begin to underperform. Now, I've tried to find data on that. Conceptually, I can see why that may be true. I've tried to find studies. They may be out there. I'm going to keep searching for them. If you know of any, shoot me an email. Let me know about them, dr@DoughRoller.net. I certainly think it's true that many do-it-yourselfers do exactly what he's concerned with, and he's right to be concerned with this. Stock market goes down in 2008, and do-it-yourselfers, sell out of fear. But guess what? I know plenty of people that had advisors that did the same thing. An advisor can't force you to stay in the stock market. They may try to talk you out of it. They may give you their best advice, but at the end of the day, you control your money. And I know plenty of people that had advisors that, I've talked to them and they, or I've talked to advisors who have said, yeah, a lot of clients fled in fear and just liquidated their account, had me move it all to cash. So I don't think the issue he's addressing is critical. We've talked about it. You got to have an asset allocation plan. You got to stick to it. And I think if you have an advisor and that person enables you to stick to your plan, you are better off with that advisor than if you do it yourself and you don't stick to your plan and you sell out of fear. However, where I don't agree with Dave is that just because you're a do-it-yourselfer, it means that you will jump out of funds when they underperform. For that matter, I also don't agree that just because you hire an investment advisor, you'll stick to your plan either. And this is something, of course, that only you can decide for yourself and for your family. I can tell you, I've been a do-it-yourselfer investor for going on 25 years, and I stick to my plan. I don't jump out. So I guess maybe I don't feel that I'm an exception to the rule. And I talk to plenty of do-it-yourself investors who stick to their guns in good markets and bad. Sometimes it can be just as hard to stick to an asset allocation plan in a good market. If you're 60% stocks and 40% bonds and the market's up 30% like it was last year, you'd be like, man, I'm missing out. It can be tough. So it goes both ways. But I'm just not as, I don't know if it's cynical or I have more confidence and faith in people, in do-it-yourself investors perhaps than Dave does. However, I do agree if you need an advisor to keep to your plan, I would look at an advisor. That doesn't mean you'd go with an endorsed local provider. There are options. We'll get to that in a minute. But as part of his philosophy, that's the very first thing you need to understand. He firmly believes you should not invest on your own. And I think I've read that he doesn't invest on his own. Obviously, I don't agree with that for everybody. I also don't like that as a blanket statement. I just think it's kind of silly. I don't know how you make that blanket statement. We're all different. I think some people do a phenomenal job investing on their own. And other people need help. And that's great. That's fine. We're all different, like I've said in past podcasts, I can't remodel my kitchen on my own. Couldn't do it for the life of me. And there are probably people listening to this podcast who think that's crazy. It's so easy to do. Well, not for me. But investing, I think I've got covered. Okay, so then why A shares? All right, fine. Dave thinks you shouldn't go it alone, but how does that get you to front-loaded A shares? Well, in this same PDF, he talks about that. He says, generally, I recommend choosing A shares, and in parentheses, he has upfront commissions. I personally do not choose fee-based planning, paying 1 to 2.5% annual fees for a brokerage account. Many financial planners suggest fee-based accounts, but I still choose traditional A-share mutual funds. That's his view. Now, not to be picky, don't think of A-share mutual funds as quote-unquote traditional. That's just not true. I mean, Vanguard's been in the business since the 70s, so I mean, Vanguard's as traditional as anything. But in any event, so there's some initial appeal if you think through these numbers with what Dave's recommending. Sure, you pay 5% or 5.75% up front, but you don't pay the 1 to 2.5% every year. So, even at the low end, 1%, you do the math, and well, if I keep my money in there for 6 years, I've broken even. I paid up front, but I'm not paying this 1% fee every year. And then after that, I'm ahead of the game. So maybe these A shares are not a bad deal. So what's wrong with that thinking? Well, there are a couple of things. And to walk through them, I want to first talk about the difference between a fee-only advisor and a fee-based advisor. So a fee-only is someone who's a registered investment advisor, RIA, fee-only. What that means is they cannot make commissions off of the investments that they sell you. They can't get paid from, say, a mutual fund to sell you shares of that fund. Not allowed to. They have to get paid by you and only by you. That's a fee-only advisor. A fee-based advisor you can think of as a salesperson. That's what they are. They're a salesperson, and they're trying to sell you something. And they'll get a commission from the mutual fund when they sell it to you. And now, you might say, well, that means fee-only is good and fee-based is bad, right? Well, no, not necessarily. Just because you're a fee-only advisor doesn't mean you're good, right? And just because you get a sales commission as a fee-based advisor doesn't necessarily mean you're bad. Doesn't necessarily mean you don't have your client's best interest at heart, although that's the theory, right? If you're getting a commission from what you're selling, how can you really align your interests with your client? And I tend to agree with that. Again, I don't think you can make this blanket statement that if someone's a fee-only versus fee-based, they're good versus bad. You really have to really vet someone, evaluate each individual. How long have you been doing this? How do you invest your own money? And all those sorts of questions. But generally, I would prefer, if I were going to hire someone, a fee-only registered investment advisor, because I want to make sure that the advice they're giving me is untainted by what they're making. So with a fee-only advisor, let's say you're paying them 1%. You're paying them 1% regardless of what you end up investing in. They have no incentive to put you in one fund over another one. They're not going to make more because they choose investment A over investment B. So that's my view. And it's not Dave's view. Dave wants, obviously he said he prefers A shares. That's his view. I just disagree with him. Simple as that. Yeah. Now, but what about the math? What about, 5% or 5+% up front's a lot, but don't want to do better over the long term? Well, a couple of things to think about. One is commissioned investment, salespeople have a reputation of moving your money around a lot. So yes, in theory, if you parked your money in, say, mutual fund A and you paid 5 or 5.75% and left it there for 40 years, wouldn't you do better than if you were paying someone else 1% every year? You would, except that you got to be careful about these commission-based advisors churning, they call it, churning the account, changing investments every 5 years, and then as a result, clipping you for another 5 or 5.75% each time you make that change. That's the first thing to consider. The second thing is you have to look at the expense ratios and costs of the underlying funds that they're putting you in. In other words, on an A-share fund, that 5 or 5.75% that you pay, that's not the only fees you pay. These funds have expense ratios, just like any other mutual fund. And beyond the expense ratio, let's just stick with the expense ratio for a second. Most of these funds are actively managed mutual funds with expense ratios that are significantly higher than a passively managed index fund from the likes of a Vanguard, okay? And I've looked at many of these. Of course, you've got to look at each individual fund, but the expense ratios for many of them are well above 1%. So not only are you paying a lot of money just to invest in the fund, you're then paying big-time expense ratios for the fund. The other thing is there are hidden costs to mutual funds that aren't captured by the expense ratios. For example, transaction costs. When the fund itself is buying and selling shares, you're getting hit with those transaction costs. And I covered this in podcast 63, DoughRoller.net/podcast 63, the 4 hidden fees of mutual funds. And for actively managed funds, those fees can be huge. For index funds, they're not. And again, you can go to podcast 63 to figure it out. So, but the point here is you got to look beyond the upfront fee versus the 1% for a fee-only advisor. You got to look at the expense ratios of the funds they're putting you in, and then you have to consider these other costs, right? Then you add that to the fact that a lot of fee-based advisors will move you from fund to fund over the course of a number of years, and you can end up paying an arm and a leg. So there's that. Then the other thing is, not all fee-only advisors charge 1%, right? I mean, that was the range that I see in Dave's investment philosophy, 1 to 2.5%. And I do think 1% is the norm. I think he's right to. I don't think there's anything wrong with the number he's put in there, except that there are plenty of advisors that charge a lot less. I mean, one tool that I use that I've talked a lot about is Personal Capital. They have a free online tool that will track all of your investments, slice and dice them, show you your performance. I use it every week. And you can check it out at DoughRoller.net/PC. That'll redirect you to the Personal Capital page. That is an affiliate link. But again, DoughRoller.net/PC. I've used them for about a year. They also offer, if you want, a fee-only advisory service. So if you wanted to hire an advisor, you could hire the folks at Personal Capital. You don't have to, but you could if you wanted to. I know they charge less than 1%. I've mentioned Rick Ferry in the past. His company, Portfolio Solutions, charges less than 1%. So, 1% is the norm, but it's not, you can do better than that. The other thing is for folks that are looking for some help, you've got more choices than just do it on your own or hire an advisor, whether it's someone like Dave recommends who charges commissions or a fee-only advisor. Those aren't your only two options. And particularly with the use of technology, there are a lot of other options out there where you can get some help with your investments, but not pay, for a full-time sort of advisor. And, Betterment is one of them. And I've mentioned other options in podcast 62, DoughRoller.net/podcast 62. Betterment's one of them. Another one are the mutual fund companies. I mean, Vanguard offers help. You can give them a call. They'll help you figure out your asset allocation plan. And they have some other advisory services. And, I'm sure most of the big mutual fund companies, Fidelity, Schwab, whatever, they have the same kind of thing that can help you. Obviously, you need to look at the details. You need to look at the costs. But the point is, you shouldn't assume that if you want help, you've either got to go with these expensive A shares or a 1% fee-only advisor. Those aren't their only options. So with that, what's my take on Dave Ramsey's endorsed local providers? You've probably figured this out. By and large, I would avoid them. I'm just not. I just disagree with Dave, and I just don't think that hiring an advisor to sell you investments based on a commission model, selling you A shares where you're going to lose 5+% right off the front, you're going to likely pay very expensive expense ratios. And let me just talk about expense ratios for a moment. One of the things that I've seen a lot in marketing materials, they'll say, our expense ratios are well below the average. Our expense ratios are just 80 basis points, and the average is 112 basis points. And if you don't know better, you think, man, that's a pretty good deal. Well, except that, you can get an S&P 500 index fund from Vanguard for like 5 basis points, I think is what it is. You might have an actively managed fund that is below the average, but that doesn't mean it's a good deal. So that's just something to think about there. So, you add the upfront commissions, you add the expense ratios, you add the other hidden costs of actively managed mutual funds. That's not a direction that I would go. So that's my view on it's really not even so much a view on Dave's ELPs program, the endorsed local provider, but as much as it is my view on using commission-based sales folks to sell you investments. It's just not my approach. Now, that being said, I would love to hear from you if you have used Dave's endorsed local provider. Maybe you have and you've had a great experience, or maybe you have and you've had not so good experience. I don't know. But either way, good or bad, let me know. I'd love to hear from you on that and hear about your experience using that program. In fact, even if you've used it for things other than investing, maybe if you've reached out and used an endorsed local provider for mortgages, taxes, insurance, whatever. If you've done that, love to hear from you and to hear what your experience was, and if you walked away thinking it was a good thing or a bad thing or whatever. So there you go. That's my view on the ELPs. And that brings the show to a close. There's the music. Hey, if you want the show notes to this episode, including links to the things I've talked about, just head on over to DoughRoller.net /podcast 69. That's where you'll find the show notes. If you haven't already, you can subscribe to our newsletter, DoughRoller.net /newsletter. Goes out every Saturday, packed full of personal finance and investing links and other goodness, as well as sort of updates of things I'm doing. I did a webinar about a week ago on how to make money blogging, and I'm going to be doing some more webinars on personal finance and investing. That's where I announce it in the newsletter. So if you're not a subscriber to the newsletter, head on over there, DoughRoller.net /newsletter, and sign up. You can subscribe to this podcast and leave a review. Just go to DoughRoller.net /iTunes. I appreciate all the honest ratings and reviews that I receive. And lastly, as I've mentioned before, shoot me an email, dr@DoughRoller.net. Love to hear from you. Until next time, remember, the best thing money can buy is financial freedom.